Ever wondered about the differences between the stock market and cryptocurrency in terms of liquidity and accessibility? Well, you're not alone. These two investment arenas have been the talk of the town, each boasting its unique features and benefits. It's essential to understand the concepts of liquidity and accessibility in both realms, as they play pivotal roles in your investment journey. So, are you ready for an exciting exploration? Join us as we dive deep into the world of stocks and cryptocurrencies. First, we need to understand what liquidity actually means. In the world of finance, liquidity refers to how quickly an asset, such as a stock or a coin, can be converted into cash without affecting its market price. Think of it like turning a solid into a liquid, hence the term liquidity. Now, why is liquidity important in investments? Imagine you're at a garage sale, and you've bought a rare antique lamp. It's valuable, sure, but if you needed cash immediately, you'd have a hard time selling it quickly without dropping the price significantly. That's because the market for antique lamps isn't very liquid. In contrast, consider a popular smartphone. If you needed to sell it fast, you could likely find a buyer quickly without having to slash the price. That's because the market for smartphones is highly liquid. In investments, liquidity is essential because it gives you the flexibility to enter or exit positions as you please, without causing drastic price changes. Now let's look at how liquidity differs in the stock market and cryptocurrency. The stock market has been around for hundreds of years, and it's a well-oiled machine. Stocks are traded on centralized exchanges during specific hours, and there's a high degree of liquidity for most listed companies. You can typically buy or sell stocks quickly and at predictable prices. On the other hand, cryptocurrency is a relatively new player in the financial arena. It operates on a decentralized network, 24 hours a day, 7 days a week. While popular cryptocurrencies like Bitcoin and Ethereum are highly liquid due to their widespread acceptance, the same can't be said for all digital coins. Some lesser-known cryptocurrencies may lack liquidity, meaning you might struggle to buy or sell without influencing the price. So, there you have it. Liquidity is all about how swiftly and easily you can convert your assets into cash, whether those assets are stocks, coins, lamps, or smartphones. And remember, the level of liquidity can vary significantly between different investments, which is something to consider when deciding where to put your money. Now that we grasp what liquidity is, let's explore how it applies to the stock market and cryptocurrency. Let's take a closer look at liquidity in the stock market. Liquidity in the stock market is all about how easily a stock can be bought or sold without causing a significant price movement. Consider popular stocks like those of Apple or Microsoft. These have high liquidity because they have a large number of shares being traded each day. This high volume of trading makes it easy for investors to buy or sell shares without significantly affecting the price. However, stocks are some smaller companies may have fewer traded each day. This volume can make it more difficult for investors to buy or sell without causing a price swing. This is known as a thinly traded or illiquid stock. Now let's talk about market hours. Unlike some other markets, the stock market isn't open all the time. In the United States, for example, the New York Stock Exchange and NASDAQ operate from 9:30 in the morning to 4 in the afternoon, Monday through Friday. These limited hours can affect liquidity, as there may be fewer buyers and sellers active outside of these times, making trades more difficult to complete. Enter the market makers. These are firms that stand ready to buy and sell a particular stock on a regular and continuous basis at a publicly quoted price. They play a vital role in maintaining liquidity in the market by providing a continuous stream of buy and sell orders. Lastly, we can't forget about regulations. The stock market is heavily regulated, which can impact liquidity. For example, regulations can limit who can trade certain stocks, how they can be traded, and when they can be traded. While these regulations are in place to protect investors and maintain a fair and orderly market, they can also limit liquidity in some cases. So, that's the liquidity scenario in the stock market, but what about cryptocurrency? Cryptocurrency, on the other hand, presents a different liquidity landscape. You see, liquidity in the world of crypto operates differently than traditional financial markets. And it all revolves around the concept of exchanges. Exchanges are platforms where you can buy, sell, or trade cryptocurrencies. The most popular ones include Binance, Coinbase, and Kraken. These exchanges essentially act as the marketplaces where buyers meet sellers. The more active the exchange, the higher the liquidity. Let's take Bitcoin, the most popular and widely recognized cryptocurrency. Its liquidity is high because it's listed on virtually every exchange, and there's a vast number of people trading it around the clock. The same goes for other popular cryptocurrencies like Ethereum and Ripple. But here's where it gets interesting. Unlike the stock market, which operates on business days during specific hours, the crypto market never sleeps. It's a 24/7, 365 days a year operation. This round-the-clock trading contributes to the high liquidity of popular cryptocurrencies. However, it's important to note that not all cryptocurrencies enjoy high liquidity. For instance, a new or less popular cryptocurrency might not be listed on many exchanges, and there might not be many people trading it. This can lead to low liquidity, meaning it might be harder to buy or sell without affecting the price. In addition, the price of cryptocurrencies can be highly volatile. Major price swings can occur, which can impact liquidity. For example, if the price of a cryptocurrency drops significantly, sellers might flood the market, but buyers might be scarce. This could lead to a liquidity crunch. On the flip side, if the price skyrockets, there might be plenty of buyers but few sellers. This could also impact liquidity. So, while the crypto market is always open, its liquidity can be influenced by these factors. Clearly, liquidity in cryptocurrency operates quite differently from the stock market. But what about accessibility? Now, let's shift our focus to accessibility in both the stock market and cryptocurrency. When it comes to the stock market, the traditional way of investing, it's not as difficult as you might think to get started. Setting up an account with a broker is typically straightforward, although it does require some documentation and possibly a credit check. The barrier here is not so much the process, but the minimum investment requirements. Some brokers require a substantial initial deposit, which can be a hurdle for those who are just starting to build their investment portfolio. On the other hand, cryptocurrency has a different set of challenges and opportunities. One of the benefits of cryptocurrency is the low barrier to entry. There's generally no minimum investment requirement, and you can start trading with just a few dollars, or even cents. This makes it an attractive option for people who might not have a lot of capital to invest initially. However, the technological requirements for trading cryptocurrency can be a hurdle for some. You need a digital wallet, and you'll have to get comfortable with the concept of digital currencies and blockchain technology. Not to mention, navigating the ever-changing landscape of cryptocurrency exchanges can be daunting for newcomers. Geographical restrictions also play a role. While stock markets are often restricted to investors within a certain country or region, cryptocurrency is a global phenomenon. Anyone, anywhere with an internet connection can potentially invest in and trade cryptocurrencies. This global accessibility is a major selling point for many cryptocurrency enthusiasts. But it's not all sunshine and rainbows. Some countries have strict regulations, or outright bans on cryptocurrency trading. So while it's technically accessible to everyone, the reality can be more complicated. As we wrap up our discussion on accessibility, it's clear that both the stock market and cryptocurrency have their pros and cons. The stock market may require a larger initial investment, but it's a well-trodden path with established institutions. Cryptocurrency, on the other hand, offers global accessibility and low entry barriers, but it comes with its own set of technological and regulatory challenges. As we can see, both the stock market and cryptocurrency offer different levels of accessibility. In conclusion, both the stock market and cryptocurrency have their unique characteristics when it comes to liquidity and accessibility. As we've discussed, liquidity refers to how quickly an asset can be converted into cash without affecting its market price. In the traditional stock market, trading is limited to specific hours and days, but it offers a high degree of liquidity due to its large volume of traders and standardized procedures. This means that you can typically buy or sell stocks at your desired price within regular trading hours. Cryptocurrency, on the other hand, operates 24 hours a day, 7 days a week, providing constant liquidity. However, price volatility can cause significant fluctuations in a cryptocurrency's value, which may affect how quickly you can sell at your desired price. When it comes to accessibility, the stock market has historically been more difficult to enter due to various barriers such as minimum investment amounts and complex trading platforms. Cryptocurrencies, however, have lowered these barriers, allowing anyone with an internet connection and a digital wallet to participate. But remember, while both offer unique opportunities, they also come with their own risks. It's important to do your own research and understand what you're investing in. This isn't a one-size-fits-all game. It's about finding the right fit for your financial goals and risk tolerance. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notifications so you'll get updates anytime we upload a new video.